Hi, today I'm with Garrett with Lendplicity Mortgage, and we are going to talk about some of the hot topics today in the mortgage industry. Thank you, Garrett, for being here today.
You're welcome. Thanks for having me.
Of course. What is the correlation between mortgage interest rates and inflation?
So inflation is definitely a hot topic in the industry right now, and we are at 40-year highs. So inflation, everybody's seeing it in the news that it's hit one of the highest points, since the early 1980s. Basically, the reason they're tied together is that in order to curb inflation, the Fed is raising the federal funds rate, which is the rate that banks borrow from other banks. And as they do that, so do mortgage lenders. So, as the federal funds rate goes up and we see these incremental increases throughout the year, mortgage lenders are also increasing as well. Now, the common misconception is that right when the Fed increases rates, that mortgage rates jump that same amount and at that same time, when in reality, the Fed starts talking about these increases well in advance, and so the market actually prices those in before they actually happen. That's why we can actually see the Fed raise rates one day and mortgage rates actually stay the same, or in some cases even come down, depending on the Fed's outlook.
So now, where do you see rates heading?
Most projections have rates normalizing in the mid to low fives, and that happening sometime around end of Q1 or Q2 next year. The funny thing is that a lot of people are saying, well, why don't we just wait to buy until rates come down? And that's definitely an option, but with lower interest rates comes more buyers heading into the market. And with that, we're gonna start to lose some of the things that we see in a current buyer's market. Things like seller concessions and price reductions and repairs. So the beauty of buying right now is, you're gonna have to sacrifice on the rate a little bit, which is temporary, but then you can go and you can refinance next year. Whereas buying next year, you get a better rate, but you may pay a premium for the home.
If rates should fall, when should a homeowner refinance to a lower mortgage interest rate?
So this is an interesting question because there's a lot of lenders out there that think there's a specific number that you have to hit for a refinance to make sense. You've got to save 1% on your rate for a refinance to have enough benefit. The real answer is a refinance makes sense when the numbers add up. And the nice thing about a mortgage is it's just numbers, right? It's just math. So, whether you're saving 0.25% or 1% or 2%, it's all about that math. I'll give you an example. Let's say a refinance costs you $2,000, but saving you $200 per month. That's a 10-month recoup on your money. If you plan on staying in that mortgage more than 10 months, then that refinance made sense. Now, let's look at another one. So let's say refinance is free. So let's say I cover all your closing costs for you. Then you don't have to save any amount of money. Whether you're saving $50 or $100 a month or $75 a month, it's all going to make sense because you didn't incur any costs and therefore you don't have a recoup time. So really what you need is a lender that's going to look out for your mortgage and reach out to you when it's time to refinance, and always make sure that you're in the best rate possible. And whether that's, a 0.25% less or 1 point less, it shouldn't matter as long as the numbers stack up.
Thank you so much, Garrett, for coming today. I really appreciate all this great information, and hopefully clears up some misconceptions out there right now in the market.